Hello folks, welcome back. This is going to be a really brief one. Obviously it's non-farm payroll week. We have daily dollar index here, and this is the weekly CBI here that we didn't quite get up into. Left relative equal highs, again, even with this high here, relative equal highs. We want to see, now that we've swept below these equal lows, nice liquidity pool has been swept, we traded down into bullish order block. Nice reaction intraday here, so we'll see if into non-farm payroll they want to make an attempt to go higher. Again, this could be again a Judas scenario where we take it lower, clear some liquidity, and we can see the long-term uptrend on dollar continue. Again, we're trying to avoid picking the top in a bullish market, and we'll see if we get any kind of continuation on the upside with the numbers released on Friday. Again, nothing really to speak of that is all that terribly interesting from a technical aspect. Price came back up, it's filled in some of this inefficiency, buy side liquidity pool. Nothing in the way of fair value up here until we get to around here. There's something really small here, but I don't really want to suggest that. This is into a bearish order block, and also takes us back to an old high. So we'll see if we can get a little bit more of a run here higher, treating this as a potential breaker, bullish breaker. If it needs to retrace from just a shallow run above this high here, then we got to watch this one as a potential bullish breaker. So you have two, a larger magnitude bullish breaker here, this candle, or if now that we've ran the buy side liquidity, if we start to slip in here, watch this candle here, right there. Okay, so that would be the near-term support. If we lose the mean threshold of this hourly down close candle or bullish order block, to me it's indicative of a further erosion in price. We'll probably want to see it trade back into, if it does that, to take out this low. And if it does that, then I'm going to be really concerned about the uptrend, not picking the top, but if it does take out this low, more meaningful to me, it would certainly suggest that maybe there's a larger trend shift underway, and we'll look for things to kind of like support that idea. Euro dollar. I tweeted a chart today, kind of like to break my silence. A lot of people were asking, what's going on, where you at? But very, very busy. We had a lot of work in the forum. I will say that some of you were emailing me, asking me why you couldn't get into some of the older archives for the weekly commentary. And I posted on the June thread for our forum that we were doing work on that I'd have it done by noon Wednesday. And we were about 20 minutes past noon before it was completed today. So all the way up to March 2018, they have all been migrated. Those links and the source files have been added to the new server. So if you're having problems watching that, you need to be using the original password that was given to you when you signed up. Some of you changed your password to get into the forum, thinking that that also changes your link password, and it doesn't. The link password is controlled by me, because I have to be able to remove access for those individuals that either don't pay their payment or break the house rules, and I have to ban them. So nonetheless, here's what we have for the daily chart on the euro dollar. We had a liquidity pool, relative equal highs here, relative equal highs here. Both of those ran out. Strong rejection at the bearish order block. The bearish order block is going to be seen inside this candle here. I found it interesting that it stopped right there and wasn't able to get up in here and clear this. I still think this is suspect for the week. So if we don't really break lower, it may want to come back up here and make an attempt to take this out. And it may require non-farm payroll to do that. So we might get an initial knee-jerk reaction and run up there and sweep that. Any continuation on the upside is rather constructive, because I think euro dollar is still the relative leader on the upside. And remember, it was the one we were reluctant on selling short because it had relative strength. So if the market's unwilling to want to drop lower when it should be dropping, like we saw with the cable market, when the markets are bullish for foreign currency, then this currency will have a very easy way of rallying. And I think it performed really nicely on the upside the last couple days. So dropping into an hourly chart, we'll zoom out a little bit here, put some day dividers in. And I'm trying to keep the charts really clean because I don't want to sell any specific narratives this week because I don't have a bias whatsoever. Usually you see me identifying like liquidity pools and SIBIs and things of that nature. I don't have any of that right now. So I'm looking at it in the truest form I can communicate to you. It's naked with just specific levels that I'm studying and referring to in hindsight. So it wasn't that I saw these things live and was paying attention to it and looking at it. It's just I'm referring to it now more or less to have something to talk about. Otherwise, I would just put a post on it and say there's nothing to look at. And I would assume that most of you would probably be somewhat offended by that because I should be able to find something to talk about, right? And I throw on my CT, I got a motor mouth. But the higher high, and this triple high here, so we have 3 drives higher, or 3 Indians pattern if you're a fan of the Street Smarts book by Linda Resch and Larry Connors. That pattern's taught there. Commonly referred to as 3 drives, but I guess they made their own name up for something that's been around. It's funny how other people do that. They don't get any flack for that, huh? Anyway, you come up with something original and they want to say that it's something entirely different. But nonetheless, watch this area here, okay? Because we have the last high swept. Traded right up into a bearish order block. Let me zoom out and let you see it and appreciate it. And if I take this off, you'll probably be able to appreciate it. Okay, so the last up close candle here, see that? So open is 113.05, 113.05, and today's high on this candle randomly goes to 113.05. Beautiful reaction there, and we break down. So this is a breaker. Okay, so the bears need to stay below this. Okay, so we want to see bear. We don't really want to see anything, really. We're just drawing the lines in the sand. I think that 112.80, which will be still inside these 2 down close candles, which makes up the breaker. Yes, it's extended, but still it's the down close candle or candles that make up the down move right before a swing high is taken. Looking at the midpoint of that, if we used the fib just to get a midpoint of that, 2 down close bodies, that takes us to right here. So if I add that, the horizontal line on the 50 level, so we want to see price basically stay under 112.70. Okay, so that's what I'm looking at. But we also have a volume imbalance in here. See that right there? Let me take this fib off. We have a volume imbalance right in the middle of that. So again, 112.70 could be interesting if we trade back up to that, fill in that volume. Let me zoom in a little bit more. Some of you maybe not seeing it. So we're missing some candle bodies in here. Yes, there's wicks and it did close entirely, but this is a volume imbalance as defined by me. So it acts like a gap. Generally, price will want to come up there and offer another more respectable amount of distribution for price. Now, when I say distribution, I'm not saying selling off or buying. Okay, it's just offering the price between this candle's open and this candle's close a little bit more, offering price more abundantly than just these 2 small periods of time where it wicked on the downside and wicked on the upside. So again, whenever I see that, my eye goes right to that, and I treat it as there was no wicks there at all, and that would be a standard gap. So we like to see these in price. It's nice to see it, but I like to see them below, just something for your notes. I like to see the volume imbalances below a breaker, because the breaker could be the deal breaker. Like, it doesn't need to go up here and do that. This could be a breakaway gap in this case. Okay, and then the market comes back up, retrades to the breaker, and then rolls over and continues on its way down, and then the dollar resumes its uptrend. In a perfect world, that's what we would see. But it's non-farm payroll week, so my storylines are always going to be trimmed on the wings, if you will. I don't want to give it too much significance, falsely attribute to what my view may be on this week, because many times I'm wrong. Okay, this is the week of the month that I'm generally wrong most of the time. So I kind of want to just allow the market to show me what it wants to do and not try to force any kind of perspective on you or try to communicate falsely that I know what's going to happen, because this week I really genuinely do not know. Okay, on to a cable chart, we have the daily here. Nice reaction, bullish order block, nice, really nice reaction there. I think this pair has the likelihood to consolidate a little bit, kind of like without this wick. Think like this little area over here. That's kind of like what I'm expecting. I'm not expecting a whole lot one way or the other with cable. I'm not terribly bearish at this point. I'm not terribly bullish. I'm just really not interested in cable where we're at right now. It's not trading at a level that finds of any significance or importance from my perspective. So I'm not really going to have too much to say about this pair. It's been drawn up. I think this may be just some measure of a premium that's being built in ahead of non-farm payroll. Hopefully we get some kind of upside surprise on dollar, and they'll want to take this thing right back down. Really nice to see how they come all the way down, closed in the single candle body on the upside. So we have a liquidity void here. Now, for definition purposes, remember when I talk about fair value gaps, you need three candles to make the fair value gap. A liquidity void is a single candle, one single candle. Now, if it opens and trades down, fills that in, that's a liquidity void. It fills it immediately. Doesn't offer this as a fair value gap. For instance, if this candle would have opened, traded down to this point here, and didn't wick all the way down here, that would leave the fair value gap for this candle when the next candle opens. Like, say this candle opened here, we could expect this to act as a fair value gap, but it doesn't offer that because it comes down and fills it immediately. So that's a liquidity void. Distinction there, just to show you what's the separation between the two, because they are not the same thing, as much as one or two people in this mentorship seem to believe. Not all inefficiencies are the same. So we have a BISI here. Okay, buy side imbalance, sell side inefficiency. Comes right back down. Beautiful filling of that here. This is a real nice example for, what was it, yesterday? Yeah, yesterday's trading and the time of day that occurred. London Open. Beautiful. That's really nice. So we had a nice BISI filled in here. Price ran away. Bullish order block. Trades down into it. Beautiful. Look at that. That's really nice. We have the high at 126.63. And the low coming in on this candle is 26.62.5. So again, beautiful delivery of price and an expansion on the upside. Trades up into what looks like the bearish order block on the hourly chart. We'll go right here to open on the last up close candle. Right, if I can get this goober to sit still. There we are. And look at that, that's beautiful. Right up into the last up close candle. All of the inefficiency on the downside completely rebalanced and then quickly ran away. So we have the same scenario for cable that we outlined for Eurodollar relative to its breaker. There is something of a small fair value gap right in here from this candle's low, 27.08, and this candle's high. So we have 5 pip fair value gap. 27.03 is the high on this one. So we have 5 pips of fair value gap in here. Basically, we need to see the bears stay underneath 127.10. We'll give it a nice round number. It could spread up to that. It doesn't need to come right to that and stop. It could go a little bit past the fair value gap and still be inside of the last 2 down closed candles. Great for this run up for a breaker. So bearish breaker, we'll define it and limit it to 127.10. And then we'll see if it wants to make an attempt to run for lower sell side liquidity. If we run above the bearish breaker and get above 127.10, then we'll be running the relative equal highs from here to here. And let's go back out to a 4 hour to get some perspective there. If we do run those equal highs, we have this wick to challenge. And if we look at this, I just taught you this last week, and that would take us to here. So midpoint on that would be 27.78, which could really easily spread to 27.80. So if we break out the, so if we break above this bearish breaker, this could be the level we reach for. Okay, and it would also signify a retracement that's being seen here as a potential optimal trade entry that would take us up into target 2 here on our fib. So again, that's assuming that we get a further erosion on the dollar index and no real upside surprise that would support continuation on the upside or bullish trend for the dollar. Real quick, I was looking at gold. Gold, we have this liquidity pool up here that's still here. Nice rally here. This, I think, is going to be the tell for the dollar. If we see gold really start to make a run above this high here, they're going to take this higher. We want to see dollar in this case. If it does that, we want to see dollar trading lower. If dollar still stays in consolidation while gold is rallying to these equal highs, that's not necessarily bearish for the dollar. It just means they're holding the dollar and allowing the manipulation on gold to run these equal highs, and then we'll see probably a more meaningful decline after this. But if we see the dollar declining when they run above this high and make an attempt to get above here, then I think it's a lot more meaningful for a bearish scenario for the dollar. So I'll be watching gold here with these reasons and those filters in mind. And dollar CAD, last bit of business. I mentioned this in brief discussion with the weekly review, which we have a rebalance to the breaker here, and the low is 135.63, and the high on this candle came in at 135.63, only off by 1 pipette. And look at the reaction there. We go down to an hourly chart. This is perfect. That's beautiful. We have a breaker here, down closed candles right for the run higher, taking out previous high. Trades to the breaker here, fair value gap, and bearish order block. There's a model in itself. That's a pattern. All you need, just trade just that, and expansion to the downside. What would you reach for? Well, if you're selling short, you want to look for counterparty liquidity pools. Doesn't this look really too perfect, too clean, too much like a support level? Liquidity is going to be below that. How much below that? Add it and just project it down. Hourly chart, if you took 20 pips below that, it's 34.23. And that's basically where we're trading at now. And it was easily hit, beautifully hit. Expanded even further. I mean, look how, that's just too good of a level, really. Really, lots of liquidity resting in there. Came all the way down, lowest close here, rejection block. Let's put that on here just for completeness sake. Beautiful. Look at the reaction there. Okay. Now, if you recall, I taught you how to use the wicks when you have these turning points. Okay, and I'll give you a more structured lesson around that this month, but it won't be until like the 3rd week. I'm still busy with payments and getting people set up, so it's very, very busy for the first couple weeks and the last couple weeks of each month. It's usually the middle of the month when I have a lot of the time to do additional lessons and such. But I taught you a week ago on how to use the wicks and applying consequent encroachment to it. And there's our close to our wick low. I'm going to take this and drop it right on the 50 level, right there. Boom. See that? Beautiful reaction there. It sends it higher. So whenever I look at wicks, I'm not just looking at the retail perspective that they always think it's a support level and therefore it's wrong. Okay, the things that I look for are going to be in alignment with obviously higher time frame theory, order flow, and what other tools are suggesting a specific turn in price. Now, I am not about to imply or suggest to you that I knew this level, because I'm looking at the charts for the first time in the last 48 hours. Okay, I've been inundated with administrative side of running this mentorship, and it's just like it's a lot. So I haven't had a whole lot of expectancy to follow price this week, as I mentioned last week's weekly review. So I'm looking at this in the same scope that if you're asking me, okay, when you're not trading, what are you doing? I'm doing these types of things here. I'm looking for signatures to support the ideas that I look for in price, and I'll counsel you to go back and go through your charts and look at every time we create a turning point with a wick. Divide that wick in half and project that out in time, and you're going to see some really stunning turning points. Okay, so they're not pin bars. Okay, they're not Steve Nielsen's favorite name of the week for a candlestick formation. All that stuff is not what I like to promote or kind of like nod my head to and support, because I don't believe in any of that. But there are certain things that I like to see that repeat themselves over and over and over again. And if the level is really good, like for this turning point here, you can get a major reaction off of that if you split the wick in half and treat it with consequent encroachment, the midpoint. Again, the wick's a gap. That's all it is. It's spreading down to get to liquidity. So when it happens, I'm not looking at just the rejection block. I'm looking at that old low here and defining it from the rejection block to the old low. So I'm using two discount arrays here. Splitting it together, what do you get? You get consequent encroachment. There's a sensitivity threshold there, and you're seeing the results of it here. I don't want to steal too much thunder from this month's lesson, but I'll just counsel you to go through your charts and find examples where you've seen highs and lows formed with wicks. Split the wicks in half and project it out in the future, and you're going to see some really, really astonishing turning points that are, if they're on a higher time frame level or time frame like hourly, for intraday purposes, hourly is like a higher time frame for me. Intermediate term would be 4 hour, which is now we're talking about swing trading. But for intraday trading, hourly is the highest form of time frame for me personally. So if we have a reaction level like this, okay, and we can split that level in half, there is not a zone. There's a specific price level. I've said this since 2010 on Baby Pips, when folks would falsely accuse everything I'm suggesting here is the canned supply and demand stuff, and it's nothing like that. It's well beyond it. I know what level I'm looking for, and I know the narrative behind it. I know why a order block is going to be bullish or bearish, and there's context to what I do. Whereas drawing supply and demand zones, I mean, if you just simply go on YouTube, okay, and you can probably do the same thing. You make the same argument with people that are trying to teach other people order blocks when I am still teaching order block theory. I haven't exhausted that. They think they understand it, so therefore they're making videos about it, when they're really just experiencing the euphoria that comes from understanding a simple concept applied at the right time. And the right time factor is what they're missing. The components of supply and demand, that's why everyone that has a YouTube channel that talks about supply and demand, there's a myriad of supply and demand zones on their chart, because they're waiting for something to line up and say, well, yeah, see how it worked there? We don't do that here. I'm looking at a specific price level, and I'm telling you this is what we're watching. This is what we're expecting to see price trade to. That's what the main takeaway is when you're part of this mentorship. There's going to be periods like I've readily admitted last weekend and still to today. I'm not real sold on one way or the other on the market, because we're going into non-farm payroll. So as a general rule of thumb, unless everything is really screaming, it's obvious it's going to do something, this is going to be the normal protocol going forward. I'm past all that proving point. Okay, I'm not trying to prove that I can trade every single day, every single week. It's exhausting, number one. It's not how I trade anyway. And I'm moving away from Twitter. So therefore, my level of activity is going to resume as it was before my soiree on Twitter. So I think we've pretty much exhausted that. Let's go down to a 15-minute time frame. And yeah, there's really nothing except for this clean high. So we'll look at this area here. You know that that's most likely the thickest pool of liquidity. Lots of folks seeing that as resistance. There's going to be liquidity pressed above that. And above that level, I don't like that as a gap. Small little area in here. So we could do this. I like this. This is a little too clean for me. And we have another one here. Right there. And then we have a fair value gap there. To 135.38. So that's the levels I'm watching. If we see dollar CAD continuously rally and gold not find a way to rally, that would be constructive for dollar index on the upside. So these are all things I'm watching. I'm kind of like treating them like plate spinning. I'm watching them all to kind of get a feel for what it may do. I'm not trying to predict non-farm payroll. I don't want to communicate that or give the impression that that's what I'm doing because I don't know. So, but I'm really interested to see what we do after Friday's close, and we have the economic numbers behind us. So that will give me hopefully a little bit more foresight going into the rest of the month of June. And unfortunately, folks, that's all I have for you tonight. When it's slow, and I don't want to make more of it than that. And when it gives me more information, there'll be more details included in the analysis. But this is what I'm watching. These are the levels I'm looking at and the thought process I'm having right now. So the scenarios and the dialogue that I have internally, I shared with you tonight. Okay, so I'll catch up with you guys by way of weekly review on Friday. I'll have that online by 4 p.m. Because I do not have the opportunity to do anything Saturday and Sunday, so I absolutely have to meet that deadline. And this week's review will have details on how we're going to be communicating, since I'm going to be trying to step away from Twitter, and we'll be using a specific thread on our forum. So you'll want to be a subscriber to that. If you don't subscribe to the threads now, you're going to want to do that after this week, because I'll be sending updates or any kind of notices that I would normally do on Twitter. I'm going to be doing everything through our forum. Okay, so with that, folks, I wish you good luck to trading. Again, it's non-farm payroll week. Don't expect too much. Relax and let the carnival ride take other people's money.